after the Central Bank of Nigeria sold about 7.3 billion naira worth of OMO bills and maintained its stance in squeezing system liquidity in defense of the local currency. So we saw the overnight money jumping to 145.25% as against 22.75 recorded on Monday, while the open buyback jumped to 141% from 21.66% recorded on Monday. And just before we brought up the interbank money market rates, we saw the currencies for the currencies market. So interbank spot market, let's start with that. Take a look at where it finished off and where it started off this morning. It's at 306 naira 10 kobo at the interbank foreign exchange market, with the British pound at 379.63. But at the street, it's continued to decline. We have it at 410 naira to $1 as at close of Tuesday, and to the British pound is flattish at 490 and 430 to the euro. So it's all about the markets, but as I mentioned, the National Bureau of Statistics will tomorrow is expected to release the March inflation numbers, and most analysts are expecting to see a continued depreciation based on base year effect. But I've got Omotola Abimbola, who's an investment analyst with AfriInvest, here with me in the studios to talk about this. So good morning to you, Omotola. It's great to have you on the program.
Good morning, Harriet.
So just before we jump into this, if you could you quickly comment on what really is driving investor sentiments around the fixed income segment of the market, because we noticed that particularly Treasury bills was a little bearish yesterday.
Correct. The Treasury bills markets and the bonds markets, they're both being driven by two major factors. First is liquidity dynamics, particularly for government treasuries. Don't forget, yesterday we had an FX intervention auction for the wholesale intervention scheme, and that led to the debiting of deposit money banks for the amount that was sold. So as a result of that pressure on liquidity, that is why we saw the sell-offs, across tenors for the Treasury bills. The second factor that is driving sentiments in the fixed income markets is inflation expectation. Traders are, anticipating March inflation reports, which is due to come out later this week. So as a result of the expectation, we are seeing traders being very, very cautious in trying to take position. If you look at the Treasury, the government bonds market performance yesterday, you saw that across a number of tenors, we had yields unchanged, compared to the previous day.
All right, so that takes us now, of course, to our main conversation, which is we're counting down to the March inflation report, and already the market seemed to be taking position ahead of the release of that particular report. Coming in from February saw for the first time in 15 months, the inflation number tapering down to about 17.78%, and most analysts are predicting that it will go down further based on base year effect. What does AfriInvest think?
We are with consensus regarding that. We also expect year-on-year headline inflation to drop by at least 100 basis points in March to 16.8% from 17.8% that we recorded in February. And we expect month-on-month inflation to also drop. We had a significant spike in February to 1.5%, due to some pressure on food prices, particularly imported food, and the seasonal impact of the planting season. But now going into March, we expect a moderation in month-on-month inflation as well, from 1.5% to at least 1.3%, because we saw some core prices drop in March, particularly diesel prices, and for food as well, the impacts of the moderation in pressure in parallel market exchange rates would have a positive feedback, on imported food prices.
Well, you're talking about food prices at the moment, and we noticed that for the month of February, that was where we recorded the highest, 1.99%. Month on month from January is 1.29%. Well, the slowest increases were recorded in soft drinks, coffee, tea, and cocoa. Have the dynamics really changed? I don't think anybody's drinking less of tea and coffee these days, but I know that we're eating more of cereals and meat and yams and tubers. All those other food products are still still heavily being consumed, and that primarily is what really drives inflation numbers.
Well, for February inflation reports, the major pressure on food prices came for the imported food segments, because we had the build-up of pressure in the parallel market exchange rates, where most of the manufacturers and also food processors source for their inputs to produce processed food. So due to that pressure on the exchange rates in February, we had a negative feedback on imported food inflation. We also had the seasonal impacts of the planting season. Nigeria's planting season usually starts between February, and it runs down towards October. Then we start seeing harvest coming by September. So this is that seasonal impact of the planting season as well. We saw a pressure on food prices, but we're a little bit more positive for March inflation regarding the food index. Like I mentioned initially, the pressure on the FX rate subsided significantly in March. The parallel market exchange rates are appreciated by over 20%. So that has a very positive impact on imported food prices in general.
Yeah.
And in fact, in addition with some manufacturers, for instance, sugar prices actually declined in March as a result of that, improvements in FX liquidity. Exactly.
So the market is now a little bit more liquid than we had it in January and maybe even in December. So that's one plus for it. But then going forward now, especially now that the Central Bank of Nigeria says it will begin to sell about $20,000 per quarter to small and medium enterprises, we definitely should see a little bit of an easing, if you'd like to call it that.
No doubt, like you mentioned, we have seen improvements in FX liquidity in March. The CBN has sold over $2 billion in both, special wholesale and retail intervention schemes, between the months of March and now, and that improvement in liquidity is being driven by the stronger oil prices as well as improvements in oil production volumes, and we believe that if those two factors remain, at least in the short to medium term, the capacity of the CBN to continue these wholesale interventions, both at the retail and the wholesale segments, will be very, very strong. So we probably expect, improvements in liquidity going forward. But regardless of that, there still needs to be a way for the central bank to start trying to bring back autonomous players back into the FX markets, and that cannot be done without relaxing some capital controls in the FX markets.
Omotola, thank you so much for your perspectives this morning on the program.
My pleasure. Thank you.
Our Business Morning continues after now. Stay with us.